So in this video, we are going to discuss about interest rate risk. So we'll first look at what is an interest rate risk for a company. Interest rate risk relates the sensitivity of profit and cash flows to the changes in the interest rate risk. So what happens is for even a small change, assume that a company has issued a lot of debt and they're also paying a lot of interest. So even for a small change in the interest rate, the company has to pay a very high amount or a lower amount than the normal one, and that leads to sensitivity of profit. We'll take an example of two companies, company A and company B. We'll take profit before interest and tax as 100 here, again as 100 for this company, and the interest is 50 for this company, and it's only like 10 for this company. So the profit before tax would be 50 for this and 90 for this company. Assume the interest rate is going to change. Okay, so interest is going to change by 10% for both the companies. So how much it's going to rise by 10%? So the 100 will be the same, but the interest will become 55 here, and the profit will fall to 45. For this company, it will be 100. If the interest rises by 10%, it will be 11 here, and the profit will be still 89. If you see the difference here, the difference is 5 rupees here, and it is only like 1 rupee here. So what happens is, this tells that the company A has a high amount of interest rate risk. Interest rate risk is faced by companies with floating and fixed rate debt. So it doesn't matter whether the company has a fixed rate debentures or a floating rate debentures. Okay, any debt that the company has will lead to interest rate risk. Interest rate risk is a risk of change in the interest rates and the effect that this will have on profits and cash flows. This type of risk is the greatest for organizations with large amounts of assets that yield interest or liabilities on which interest is payable. So it is not only company that is like issuing a lot of debentures that are going to be affected by interest rate risk. It is also companies which have a large amount of assets that yield interest. So assume that a company has a lot of reserves, and all these reserves are being like deposited in debentures or bonds. So even a change in that interest rate, what would happen? It will affect the income pattern of the company here. So it's not only the company which has debt in the terms of bonds. Okay, it is also a company which has investment in terms of bonds. Okay, so it affects both kind of companies. Banks and investment institutions are heavily exposed to interest rate risk, but also companies with large borrowings. So it also affects companies who invest, also who borrow. So it affects both kinds of companies. So that's about the interest rate risk. So now we look at what is a floating interest rate debt. The most common form of interest rate risk faced by a non-bank company is the volatility of cash flows associated with the high proportion of floating rate interest debt. So for again, we'll take two companies. So we take company A and we take company B. So both companies have a profit before interest and tax of 100 and 100, and the interest rate for this company. So this company has issued a floating rate interest. That is, the floating rate usually keeps changing from year to year. So they have around they have issued a 100 rupee bond, and they are going to pay something like 10% out of it. So 10 rupees is the interest here, and the profit before tax works around 90. So this company B, has issued fixed rate of loan. So that means they also are going to pay 10% of interest. So that also comes to 10. So they also have the same PBT of 90. See, the problem arises when the interest rate is going to change. In a floating interest rate, the interest rate is periodically reset. For example, once in a year, once in 6 months, or once in 3 months. So what would happen is, even though the company earns 100, the interest might change to from 10% it might go to even 11%. So what happens is this might become 11 and the profit will become 89. For a company B, as it is the same fixed rate, whatever is going to be changing in the floating rate will not affect the fixed rate. So it will have the same 10. So what would happen is the 90 will always be 90. But here in a floating interest rate, the interest rate will keep changing and it might become even to 89. It's not that it will go to the worst part. It might even become better. For example, the interest rate might also fall in floating interest. So it can also become 9. So what would happen is now when the interest rate falls, the company will be earning a little bit higher. So which one is better? Company A has a fluctuating interest rate. Company B has a fixed interest rate. Fixed interest rate gives you a calmness because you know like what is going to happen. You are going to pay for example 10% as the interest for the next 5 years also. But in floating rate, you're going to pay a different rate for even a 5-year loan. So every year, if the interest is going to be reset, you're going to pay a different amount of interest. If it's going to become 9, you are happy, but if it becomes 11%, you have to worry. So that's about the floating interest rate. Interest rates are periodically reset at every 3, 6 or 12 months. So floating rate interest rate has to be like periodically reset. So once in every 3 months or 6 months or 12 months, the rate would be like changed and a new rate would be issued. The company which has borrowed has to pay the new interest rate only. Interest rates on this debt will rise and fall in line with changes in a reference interest rate, such as the bank's rate or the London Interbank offered rate, which is called as the LIBOR. So, the periodical resetted floating rate depends upon some other reference rate called as the LIBOR rate. The specific interest rate for every company depends upon its risk profile. Specific interest rate equals to the reference interest rates, that's the LIBOR, plus or minus the company's risk. For example, if company A borrows loan, they have to pay LIBOR interest, which is a general interest, plus the company specific risk also. So for example, LIBOR might be like 10% and the company specific risk can be like 5%. So together it will be 15%. But if company B is going to borrow a LIBOR based loan, the LIBOR will be the same 10%, but the company specific risk can be like 2%. So the interest rate for each and every company in floating rate will differ depending upon the company's risk nature. So now we look at what is a fixed interest rate debt. A company with a high proportion of fixed interest rate debt has a commitment to fixed interest rate payments. So you might think that a company which has a fixed interest rate is much more calm, is much more safe when compared to a company which is like having a floating interest rate. The answer is not like that. Even if a company has a fixed interest rate debt, still it faces a lot of risk. For example, we'll take like again two companies. So company A, which is our company, and our competitor whose company B. Okay, so again we'll have the same PBIT. We have the PBIT of 100, and then we'll have the interest. So our company, what they do is they have a fixed interest rate. They have a fixed interest rate of 10% on 100. So they're going to pay 10 rupees, whatever is going to happen. So our company is going to have 90 rupees as the PBT. But if you take our competitor company, they are going to pay interest, but on a floating terms. So on floating terms, they pay 10% on 100. So they are also like us, PBT of 90. So what is the problem if you're going to pay a fixed interest? The problem does not occur from our side, but our competitor side. Assume the floating rate interest is moving from 110% to around some 8%. What would happen? The interest they pay will not be 10, it will become 8. The profit that they will earn will become 92. So again, what is the problem here? The problem is the company now earns 2 rupees extra when compared to us. So again, what is the problem? The problem is this 2 rupee income that they get, they might give this 2 rupee as discount to the customer, to the customer. So effectively, if they give the 2 rupees to the customer as a discount, the company will earn only 90. It's the same 90 as what we had. Okay, but what they have in addition to us is their selling price would have been reduced. Their selling price is effectively reduced by 2. So so what would happen is customers will move away from us to them. Okay, but even though this is not like permanently like possible, but because the floating interest rate will keep on changing, it might even go to from 8% to 11%. At that time we'll have a competitive edge over them. But assuming that the interest rate moves like this, we have a fixed interest rate of 10%, and they have also starting at 10%, but over a period of years the floating rate falls down. Okay, it starts at 10% but falls to something like 5%. So when compared to company A, company B gets an advantage over a period of 5 years. So that is a major problem for the company here, because the competitor B has a floating interest rate and the interest rate over a period of time falls down, but we are now stuck with the fixed rate commitment where we have to pay 10% irrespective of whatever happens to the floating interest rate. So the fixed interest rate is also a kind of problem, but it is not a direct problem to a company, it is only an indirect problem to the company. If interest rates fall sharply, the company will suffer from a loss of competitive advantage compared with companies using floating in rate borrowing, whose interest costs and the cost of capital will fall. So if an interest rate falls very sharply, it doesn't hurt us because we are already in, it will not benefit us because we are already in fixed interest rate, but it will lead us to a loss of competitiveness because that company or competitor, his interest cost falls and his cost of capital now effectively falls. So what happens is it leads to loss of competitiveness. This means that a company with fixed rate debt has exposure to interest rate risk, just as a company with a floating rate debt is exposed to interest rate risk. So it doesn't matter whether you have fixed rate debt or floating rate debt. A company, if they have debt, they are exposed to fixed interest rate. They are exposed to interest rate risk. So we'll start with the next risk. It's called as asset and liability management. Fixed interest rate for payments or earnings may have different maturity time scales. Asset and liability management aims to achieve similar duration for payments and earnings. For example, a business has a 10-year loan on a building at a fixed rate of 5% per year. So a company has a building with a 10-year loan and it pays a fixed rate of 5% per year. So now this company, it rents out the building for 6 years at an interest rate of 7%. This is fine for 6 years, but then if the rental yield falls to 4% per annum, the business will start to lose money. So what happens here is the company has bought a building at a 10-year loan, okay, at a interest rate of a 10-year loan, okay, at the interest rate of 5%. So this is their expense, but they also have an income. The income works for 6 years and the income is going to be 7%. So the company effectively earns 2% as their income. For 6 years it is okay, but what would happen after the 6 years? If the interest yield falls after the 6 year, okay, for the next 4 years, if the interest yield falls to something like 4%, the company will negatively earn 3%. So that would be the problem here. So that is called as asset and liability management. So the company has to, so what should the company do? The company should enter into a 10-year lease, okay, at a 7% or at even 6.5 is okay. So the company should effectively enter into a 10-year lease 10-year lease at an interest rate of 6.5%. Okay, so that what would happen is the asset liability is now matched. A safer option would have been to match the loan period to the rental period. So that's what we discussed just now. So the next risk is called as gap exposure. Gap analysis is based on the principle of grouping together assets and liabilities which are sensitive to interest rate changes according to their maturity dates. Two different types of gaps may occur. A negative gap where the liabilities are higher than the assets. So what happens is a company has both the interest rate asset and a liability which is based on an interest rate. So sometimes the liabilities are more than the assets. So if the interest rate goes up or down, it hurts one part of the equation a lot when compared to the other. A negative gap occurs when a firm has a larger amount of interest sensitive liabilities maturing at a certain time or in a certain period than it has interest sensitive assets. The difference between the two amounts indicate the next exposure. So you'll have like this: the company has 10 crore of loan and the company also has 5 crore of investment in debt, okay, in bonds or something. So in net effect what happens is now they have a 5 crore of liability mismatch. So this liability mismatch becomes the gap exposure. So the gap exposure is negative because the liability is higher when compared to the asset. So this leads to an exposure of a higher amount of liabilities compared to the assets. But you can also think in this term. This helps in the netting of the asset and liability. The company doesn't need to take an hedging for this and a hedging for this. Okay, they don't need a hedging for 15 crore. They just need a hedging for the 5 crore because only the 5 crore is an unhedged position. The 15, the 10 minus 5, okay, it is like naturally hedged. The other 5 alone has to be like hedged externally. So that is about the risk exposure. A positive gap where the liabilities are lower and the assets are higher. So the liabilities are lower and the assets are higher. In that term, it's called as a positive gap. That is a positive gap if the amount of interest sensitive assets maturing in a particular time exceeds the amount of interest sensitive liabilities maturing at the same time. So even if a company wants to hedge this position, they can still hedge, but after netting both these numbers, they can hedge the remaining amount. So we look at another risk which is called as the basis risk. It may appear that a company which has sized matched assets and liabilities and is both receiving and paying interest may not have any interest rate exposure. For example, a company has a 5 crore worth of loan, okay, and they also have 5 crore of investment, okay. So both these positions are hedged, okay, and there's no gap exposure. But the problem he says is if they are not going to be like having the same maturity dates, okay, if they are not going to be having the same maturity date, then there's going to be a problem. For example, the 5-year loan is for 5 years, okay, and the 5-year investment is for 15-year investment. Now will the interest rate for both the loans, for both the instruments, will they move in the same place accordingly? The answer is no. However, the two floating rates may not be determined using the same basis or benchmark. So one can be in LIBOR, okay, the other can be in Mumbai Interbank Offer Rate, MIBOR. So the loan can be based on one reference rate and the investment can be based on another reference rate. For example, one loan may be linked to 1 month LIBOR and the other might be linked to another 6 month LIBOR. So even though it is going to be the same LIBOR, Okay, the duration can change, the duration of the loan can change, and that can be a problem. So we'll still look at what is basis risk. So if you look at this diagram, you will see that this is a blue color line is a 1 month LIBOR and the green color line is a 6 month LIBOR. So you might clearly see the blue line to be different than the green line. The blue line is somewhere here. The green line is somewhere here. So everywhere you look, the blue line is always lower than the green line. So even though assume that and this 1 month LIBOR is a loan and the 6 month LIBOR is the asset. So you might see that the loan interest and the asset interest will not change exactly. So if you put that the loan interest is 5% and the asset interest 8%, okay, so suddenly they change. Okay, so what happens is the loan interest rises by 2%, it adds by 2% and it becomes a 7%. But here also we can't expect the same 2 to be added. Somewhere it can be added by 3%. So this might become a 11%. So it's not that they will change exactly as the same number. They might change with a different number and might give a different answer. So even though you are like your asset is equal to your liability, your interest rate asset is equal to interest rate liability. This is matched. So there's no gap exposure. Even though there is no gap exposure, as the loan interest rates are in different maturity times or they have a different reference rate, they will not change in the same manner, thereby it might not offer you a hedge. So in this slide we'll be like discussing about yield curve. The term structure of interest rates refer to the way in which the yield on a security varies according to the term of borrowing. The interest rate for different maturities of a debt can be shown graphically in a yield curve. Normally, the longer the term to maturity, the higher the rate of interest. This is shown by the normal yield curve in the diagram. Occasionally, interest rates may be higher for short-term maturities than long-term maturities. When this happens, there is a negative yield curve, which is also illustrated in the diagram below. So we look at what is an yield curve. So yield curve is a representation like this. On one axis, you have the term to maturity. For example, you might have a 1 year maturing bond and you might have a 10-year maturing bond. And what does the interest, the rate of interest for that 1 year bond in the market? Okay, so normally what they indicate is the shorter duration bonds have a lower interest rate and the longer duration bond has a higher interest rate. So usually the interest rate will be like going upwards with the nature of the time, with time. So the higher the time, higher will be the interest rate, and lower the duration of the bond, lower will be the interest rate. But occasionally what happens is the longer term interest rate can be below the short term interest rate. So this is called as the downward sloping yield curve. So there are like different types of yield curves. For example, if you take this to be a 1 year bond and another 10-year bond, so you can see here the interest rate is always flat. Yield curve can also be like this. If you take this bond, it has a 1 year yield which is lower and the interest rate for a 10-year bond is much more higher, and this is called the normal curve. In this diagram, we see that the 1 year interest rate for a bond is higher than the 10-year interest rate, and this is called the inverted yield curve, or it can also be called as a negative yield curve. This is another yield curve where the 1 year bond is lower, and for the 5-year bond, the interest rate is higher, and for the 10-year bond, it is again the interest rate is lower here. So it can also be that in different term structures, okay, the yield curve can go up and down. So there are like different shapes and yield curve can take. Why interest rates differ for different maturities? So we just now saw that for a 1 year loan, okay, for a 1 year loan, the interest is lower. And if you take a 5 year loan, the interest rate is higher. So this is like expressed through the normal yield curve. But why does this occur? To explain this phenomena, there are like different theories. The first theory is called as liquidity preference theory. The liquidity preference means investors prefer having cash now to deferring the use of cash by lending it or investing it. We can explain this through an example. For example, your friend asks you a loan. Your friend asks you a loan, and he asks you an amount of 1 lakh, and this 1 lakh is for 1 month. Now, will you charge him any interest? The answer is no. It's very like a very short period. Okay, you just want a 0%. Assume that the same friend, instead of asking you a 1 month loan, he's asking a 1 lakh loan for 5 years. So what happens is, will you charge the same 0% interest? The answer is no. Now you feel it is little bit risky to give it to him, and you might say, or you might ask something like a 10% loan, okay? Or he says, your friend says, so if you feel risky, I'll give some gold jewels at my home to you, and you give me the loan. So even at that point of time, you will feel that, okay, as I'm getting golds as a collateral or as a pledge, what I'll do is I'll reduce my interest rate to 5%, okay? So earlier you were the same person who offered him 1 lakh at 0% interest, but now you are trying to charge him a 5% interest. Okay, why does this happen? Because you feel in 5 year time anything can happen. Your friendship can break, he can become poor, or he might run away with your money, might even die in that period. So there is a risk of the money not getting returned back. So the risk is always higher in the longer run. The risk is higher in the longer run, but the risk always lower in the shorter run. So the risk is what determines the interest here. The same logic we can also apply to a company. You take a company and they want to give a loan, okay? So you take a company and they want to give a loan, a 1 year loan to another company, and there's also a 5 year loan to another company. In 1 year, the chance of bankruptcy is lower, but in 5 years time the same bankruptcy is higher in nature. So the risk is lower in the shorter duration. In 1 year time the company might not be closed, but in a longer 5 year time there might be a chance that the companies can get closed. Okay, as the risk is lower, you will charge a lower interest rate. As the risk is higher, you will charge a higher interest rate. So if you look at here, the 1 year loan, that is why it is having a lower interest rate, and the 5 year loan, that is why it is having a higher interest rate. So the in between data is the logic for why 1 year loan is lower and the 5 year loan is having a high interest rate. So investors also prefer having cash sooner to having cash later. The sooner the cash, the better. So they also prefer the cash to be of a low duration loan. They therefore want compensation in the form of a higher interest, higher return for being unable to use their cash now. So they want cash immediately. If the cash is not available, then they will only ask for a much more higher interest rate. The required return increases with the length of time for which the cash is unavailable. Because of this, long-term interest rates such as bond yields tend to be higher than short-term yields, and the yield curve slopes upwards. So it is purely for the basis of liquidity. So people want more liquidity, and liquidity is given more preference. The higher the liquidity, lower the interest rate, and the longer the period of loan, the lower the liquidity, hence the higher interest. So if you see, without liquidity premium, the curve might even be flat. But as investors in the market wants a premium, so what they do is they want a higher, they charge a higher amount of interest for the longer duration of time. The liquidity preference theory has a drawback. This theory cannot explain any other yield curve. For example, we have other yield curves like the negative yield curve, or the humped yield curve, or the flat yield curve. These curves cannot be explained by the liquidity preference theory, because the theory states that people will always want a higher return for the longer duration of time. So if liquidity preference theory correctly states this, it cannot state this or this or this. So that is the drawback of liquidity preference theory. Why interest rates differ for different maturities? We look at a second theory. It's called as the expectations theory. Expectations theory states that interest rates reflect expectations of future changes in interest rates. So in this theory, they feel that the markets have expectation of what would be the future interest rate, and according to that only the current interest rate keeps changing. So it works like this. So if you feel the price of potato, okay, in 5 days time, it's going to become like 100 rupees, but the today's the same potatoes price is around some 20 rupees. What would happen? The next day the price will go to 40. Okay, in the next one day it will go to 40. The next day, in the second day, it will go to something like 60. In the third day it will go to something like 80. The fourth day it will go to 90, and in the fifth day it will go to 100, because that is what you are expecting. Okay, you are expecting the price to be 100 rupees in the 5 days time. So the price gradually keeps climbing and it reaches the 100. So this is what is called as expectations theory. If interest rates are expected to rise in the future, the yield curve will slope upwards. So if interest rates are, the current interest rate is here, okay, and in the future it is going to be here, means the interest rate will be like this. So it is an upward or a normal yield curve. But if interest rates are expected to drop, it can also like fall to the inverted or negative yield curve. So it can be a negative yield curve. Okay, this theory can explain whatever like different types of uh, yield curves are. So it does not only like explain the normal yield curve, because the earlier liquidity preference theory can explain only the normal yield curve, but this expectations theory can explain any yield curve, because it is only the expectation which determines the yield curve. So it can be easily explained by this theory. When interest rates are expected to fall, short-term rates may be higher than long-term rates, and the yield curve can be downward sloping. Thus, the shape of the yield curve gives an indication about how interest rates are expected to move in the future. So, how the yield curve like shapes out, that is what the market is also expecting the interest rate to move. So, we'll move on to the next theory. The next theory is called as market segmentation theory. Market segmentation theory of interest rate suggests that the slope of the yield curve will reflect conditions in different segments of the market. This holds that the major investors are confined to a particular segment of the market and will not switch segment even if the forecast of the likely interest rate changes. So we look at the picture. So this theory says that every duration of loan are a different kind of segments or markets. Okay, so there are like buyers and sellers in this small segment. For example, a 1-year loan segment, and there are also like buyers and sellers in the 5-year segment, and there are also like buyers and sellers in a 10-year loan segment. So there are like different types of buyers in each segment. So each of them will going to determine the supply and demand, and they form a point. So each of them determine a small point, but only when you add these points you get the normal yield curve. Okay, assume the 5-year interest rate is, the supply demand is going to be pointed here, and the 10-year loan is going to be pointed here. What would happen? If you mark all the points, it comes to a negative yield curve. So again, market segmentation theory can explain any type of yield curve. So it can explain a flat curve, a upward sloping, a downward sloping, or a humped yield curve. So the yield curve is not a single line. It is actually a different types of markets, and in each market there are like different buyers and sellers. Their interaction is only like determining a single point. Okay, only when we connect the points we get the yield curve. That is called as the market segmentation theory. So the interest rate is also affected by the government's policy of keeping interest rates relatively high, may have the effect of forcing short-term interest rates higher than the long-term rates. Similarly, a government may have a policy of very low short-term interest rates. In the USA or Eurozone or the UK, the central banks are responsible for managing short-term interest rates through the rates at which the central bank lends to the banks. So, even the government policy can affect it. For example, if the normal interest rate is here, okay, short-term interest, and the long-term interest is somewhere here. So the curve is a negative sloping curve. What the government can do is, the government will start to will try to buy a lot of bonds from this market, the 1-year short-term market. As the government buys bonds, okay, what happens is, the bond will move to the government and the cash will move to the market. As now there is a lot of amount of cash in the market, the interest rate will start to fall. Now the curve can even be a flat curve, or if the government is very aggressive, it can also be a normal curve. So the government has the power to convert any curve. So that is what is like told here. So what are the various factors affecting the interest rates in an economy? Need for a real return. So every investor wants a return which is adjusted for inflation, or return after inflation. So that is what real return refers to. Inflation, the interest rate is also determined based upon the inflation in a country. Uncertainty about future rates of inflation. Liquidity preference of investors. Balance of payment or deficit in the government's account. Monetary policy of the government. These are the factors which determine the interest rate in an economy. So we'll see a quiz. In relation to the term structure of interest rates, what is an inverted yield curve? An inverted yield curve is something like this. So it's not an upward sloping, it is not U-shaped, it is a downward sloping, it's not horizontal. Okay. So the answer should be B. The answer is B. We'll move on to our next question. Which of the following statement is correct? Governments may raise interest rates, so the level of expenditure in the economy will increase. If you increase the interest rate, the level of expenditure in the economy will fall. It will not increase. So this is wrong. Normal yield curve slopes upward. Yes. To reflect increasing compensation to investors for being unable to use their cash now. This is correct, and this is explained by liquidity preference theory. The yield on long-term loans is lower than the yield on short-term loans. Yes, this is correct, because long-term debt is less risky. No, this is not less risky. It's actually more risky for a company than a short-term debt. This sentence is correct, but this explanation is wrong. So the answer is wrong. Expectation theory states that future interest rates reflect expectations of future inflation rate movement. It's not future inflation rate movement, it is future interest rate movement. So the answer is wrong. So the answer should be B. The answer is B. have another quiz. So the following statements are correct. The general level of interest rates is affected by investors' desire for a real return. Yes, because investors want a real return. Market segmentation theory can explain kinks or discontinuities in the yield curve. So what is a kinks? Kinks works like this. The interest rate is the normal yield curve will be like this, or an inverted yield curve can be like this. Kinked curve is something like this. Short term might be lower, the medium term might be higher, and the long term might be lower. So this is a kinked curve. So market expectations theory can explain the kinked curve. The answer is yes, because it divides the market into segments: the short term segment, the medium term segment, and the long term segment. Each segment is a different market, so it can explain any yield curve. When interest rates are expected to fall, the yield curve could be sloping downwards. The answer is yes. When interest rates are expected to fall, the yield curve will also fall. So all the three are right. So the answer should be D. The answer is D.